Hello everybody, I'm Huang Shiyuan from Legal and Compliance Department. I'm really honored to be here today on behalf of my team to share our knowledge and research of international regulatory regimes and special features in INE's rules. First things first, I would like to remind you that because both foreign and domestic regulations may change or be abolished, continuous attention is strongly recommended and required. The research and information shared today may be incomplete and the content is only for reference, which could not be used as basis for conducting specific business. To those who are not very familiar with China's futures market, I would like to start by sharing a brief overview of our futures market history and structure. In 1988, China officially began preparing its own futures market. After 30 years of development, China has gradually developed a mature trading market with a sound regulatory structure and great international influence. The key idea of China's regulatory structure surrounding its futures market can be phrased as 5 organizations in one unit. In this unit, China Securities Regulatory Commission, the CSRC, performs unified supervision duties for futures markets. This is done in accordance with laws, regulations, and authorization of China's State Council. Meanwhile, the regional offices directly governed by the CSRC aim in assisting the CSRC in regulating China's futures market in a unified and centralized manner. Furthermore, China's Futures Association, the CFA, is a national non-profit self-regulatory organization. Under the direction of the centralized supervision, the CFA implements futures industry self-discipline management. In China, we also have China Futures Market Monitoring Center, or the CFMMC, which is a non-profit organization established by the State Council and the CSRC. Its main functions are monitoring futures margins and futures operations, providing investor trading and settlement information lookup, governing futures investor protection funds, and integrating futures investor account openings. The last components of the unit are futures exchanges. Their duties are to provide venues and facilities, organize and supervise centralized futures trading, and implement self-regulatory management. China now has 5 futures exchanges. They are Shanghai Futures Exchange, SHFE, Zhengzhou Commodity Exchange, ZCE, Dalian Commodity Exchange, DCE, China Financial Futures Exchange, CFEX, and the Shanghai International INE Exchange, INE. In 2019, China's futures market further cemented its important position in global futures market. According to the 4-year trading volume data from the FRA, SHFE, DCE, ZCE, and CFEX are respectively ranked 10th, 11th, 12th, and 28th globally based on the trading volumes of exchange-traded derivatives. When particularly looking at the trading volumes of exchange-traded commodity, SHFE, DCE, and ZCE probably held global rankings of 1st, 2nd, and 4th, which is an absolutely outstanding achievement for China's futures market. In part 1 of today's presentation, I would like to quickly go through the chronology of INE and also briefly explain how the supporting policies work to make the globalization of China's futures market finally happen. Registered in China Shanghai Pilot Free Trade Zone on November 6, 2013, Shanghai International Energy Exchange Corporation, or INE, is an international exchange jointly initiated by SHFE and the Shanghai Futures Information Technology Company. INE is a self-regulated entity approved by the CSRC and is the very first futures exchange that opens to global participants in China mainland. Up to now, INE has launched 4 futures contracts: crude oil futures in 2018, TSR rubber futures in 2019, while low sulfur fuel oil futures and bonded copper futures in 2020, among which the crude oil futures draws the world's most attention. The won the FOW Award of Best New Derivatives Contract in 2018. The Wall Street Journal spoke highly of the crude oil futures contract as well, publishing an article on July 1, 2020, saying that higher trading volumes in the last couple of years, combined with the relative stability of Chinese oil prices this year, have helped increase global appetite. Meanwhile, in 2018, INE took one brief step abroad and was successfully approved as an automated trading service in Hong Kong. INE was also approved as a recognized market operator in Singapore, becoming the first mainland futures exchange to be licensed by SFC and MAS, jointly enhancing the impact and its visibility. Additionally, the CSRC have formally approved INE as a qualifying central counterparty in 2019. Having been recognized by the CSRC, it's the first step that INE fulfills its QCCP duty comprehensively, meaning INE have been taking part in the global cooperation and the competition according to the international standard. In June 2019, the European Securities and Markets Authority, the EU's security market regulator ESMA, published an updated opinion on post-trade transparency under MiFID II and MiFIR, together with its annex list covering the post-trade transparency assessment results of 136 third-country trading venues. Based on its assessment, ESMA has concluded that both HHFE and INE meet all the relevant criteria and are therefore added to the positive list. European Union investment firms concluding transactions on TCTVs included in such list are relieved from the obligation to make those transactions post-trade transparent via an approved publication arrangement. We already know that the crude oil futures contract is the first futures contract that opens up to global investors, but without all the help from the State Council, Ministry of Finance, State Administration of Taxation, the CSRC, the People's Bank of China, the State Administration of Foreign Exchange, and the General Administration of Customs, etc. The goal of globalization is impossible to achieve. Next, I will discuss a time schedule of policies issued by the above authorities from 2012 to 2018, regulating all aspects of the process, including trading, clearing, settlement, declaring, and tax reporting. In April 2015, the MOF and SAT issued a notice on the value-added tax policies for the bonded delivery of crude oil and iron ore futures contracts, which provided the bonded delivery of crude oil futures is to be VAT exempt until further notice. In June, the CSRC issued interim measures for the administration of overseas traders and overseas brokers' engagement in trading of specified domestic futures products, which determined the design of crude oil futures contract as one of the specified domestic futures products, and provided rules and regulations regarding the access of overseas investors and brokers, laying the foundation for China's futures market opening to the world. Later on in July, the PBOC issued an announcement on matters concerning the administration of cross-border settlement of domestic crude oil futures trading. The announcement specified the pricing and settlement of currency for crude oil futures, the opening of renminbi account, and the methods for calculating interest. The announcement also clarified the special account management, the requirements for anti-money laundering and anti-terrorist financing. In the same year, on July the 31st, the SAFE issued a notice on administration of foreign exchange for overseas traders and overseas brokers trading in specified Chinese futures contracts. This is different from QFII and the Shanghai-Hong Kong Stock Connect, providing an innovative and suitable method for futures market to supervise and manage the foreign exchange. In August 2015, the former General Administration of Customs issued the Customs Administration for bonded delivery of China's crude oil futures contract to support the development of bonded delivery business of crude oil futures. In February 2018, the former General Administration of Quality, Supervision, Inspection and Quarantine issued a notice on the administration of quality supervision and inspection of crude oil futures, which clarified the requirements of inspection and the supervision of crude oil futures. In March 2018, the Ministry of Finance and the State Taxation Administration issued notice on the futures trading and income tax exemption for offshore institutional and individual traders temporarily. All these policies have laid a solid foundation for INE to provide a more convenient international standard trading platform, and also a user-friendly environment for domestic and overseas traders. This concludes the overview of China's futures market, and now we will move on to the second part, the important innovations in INE's rules. The design of INE's rules is based on four principles: internationalized platform, net pricing, bonded delivery, and the renminbi denomination. The first principle, internationalized platform, is about the trading, clearing, and delivery at INE, which adopts a global standard so that the market is freely, efficiently, and conveniently accessible for onshore as well as offshore investors, including foreign companies, trading houses, and investment banks. The second principle, net pricing, is about having a clean price prior to customs duty and VAT. It is different from after-tax pricing of futures contracts listed on other Chinese futures exchanges. This arrangement facilitates direct comparison with other global futures prices and eliminates the impact on the futures prices of any tax policy change. The third principle, bonded delivery, is about the physical delivery performed using a commodity, which is under bonded supervision and within the bonded supervision premises as the underlying product for delivery. The main purpose of this practice is to ensure that the spot market of the bonded commodity goods is net priced prior to the imposition of tax. The fourth principle, renminbi denomination, is about daily settlement variation and the physical delivery settlement of the futures contract as denominated in renminbi, while US dollar and other foreign currencies specified by the exchange could be used as margin collateral. However, there are still a few certain practices carried out in INE, which are common to other futures exchanges in China. These will be new and unfamiliar to foreign investors, such as one trader, one ID coding policy, pre-margining, position limit, and risk management regimes. Next, I will quickly go through some provisions that are legislation related, and my colleagues from other departments will cover the remaining aspects. The first concept I would like to highlight here are central counterparty and the close-out netting. As a central counterparty, INE will interpose itself between counterparties upon execution of a futures trade. INE becomes a seller to the buyer and the buyer to the seller, adopts the net settlement method, and finally ensures all settlements and deliveries for centralized futures trading. Furthermore, the general exchange rules of INE provide that the legal attributes of the property rights are derived from the activities such as trading, clearing, and delivery of executed orders. Other legal attributes of the property rights include position closed, cash received as margin, assets, and standard warrants paid for delivery. Additionally, those actions adopted by the exchange against any default event shall not be revoked or considered null due to the initiation of bankruptcy proceedings against any member. In the event that a member enters into insolvency proceedings, the exchange may still conduct a net settlement for such members' positions in accordance with the general exchange rules and the other related rules. Next, I will go over the eligibility rules, or give its full name, Futures Trading Participant Eligibility Management Rules. These eligibility rules are formulated to promote rational participation in futures trading, safeguard all traders' legitimate rights and interests, and ensure the stable, legal, and healthy development of the futures market. Eligibility standards vary with different futures categories. I will take crude oil futures for example. Any investor intending to participate in China's crude oil futures market should meet the requirements set in the eligibility rules, including but not limited to the following: having full capacity for silver contracts, understanding the essentials of futures trading and the rules of INE, having passed relevant tests, having futures trading history and records. For individual investors, having a cash balance of no less than renminbi 500,000 or its foreign currency equivalent in his or her margin account, lasting for more than 5 business days before applying for a trading code. And for institutional investors, the number is 1 million renminbi or foreign currency, having no material adverse credit records, and is not banned from the futures market by the competent authority, having never been prohibited or banned from engaging in futures trading pursuant to any laws, regulations, and the rules of China or any rules of INE. All eligible traders need to abide by the laws and regulations of China, the rules of INE, as well as the laws, regulations, and the regulatory rules of their home jurisdiction. The next subject is the head or self-regulatory settlement. It is really a new attempt for both INE and all other Chinese exchanges. First heard of the word self-regulatory settlement, somebody might confuse it or conflate it with the plea bargaining system in the United States, or with administrative reconciliation on the CSRC level. But in fact, the self-regulatory settlement here is a different concept. The self-regulatory settlement in INE's rules means the exchange may, during its investigation of suspected rule violation by citizens, legal persons, or any other organizations, accept an offer for settlement by such respondents. The exchange may enter into a settlement agreement with such respondent and terminate the investigation after reviewing the offer and reaching an agreement on issues including making rectifications, eliminating the negative consequences caused by the rule violation, and paying for the settlement by the respondent. What needs to be stressed is that the self-regulatory settlement is only applicable when the exchange has already filed a case and has conducted necessary investigations, but relevant facts or legal status of the case still remain unclear, and the respondent is willing to take effective measures to compensate the trading participants that have suffered the loss. In cases that the facts are clear and the supporting evidence is sufficient, or the respondent is suspected to have constituted a criminal offense, the exchange shall not enter into a settlement. The final feature of this section is overseas taking delivery. INE made its first attempt and exploration to expand the delivery service globally, starting with innovative arrangement on delivery storage facilities, adjustment of premiums and discounts. As multinational corporations have global trade network and allocation capabilities, thus are capable of managing both domestic factories and overseas commodity storage facilities collectively. By combining the group delivery business of multinational corporations and the rules on the factory of trading houses, INE introduced the overseas commodity storage facilities to offer convenience for overseas investors to take delivery overseas. The holder of the standard warrant can, based on its own intention and its qualification, and through the group commodity business provided by the group to which the warehouses and the factories belong, take delivery overseas upon agreement. The domestic delivery storage facility shall repurchase the standard warrant and assist in coordinating with the overseas commodity storage facilities. The customer and the overseas commodity storage facilities shall sign the sales contract with the same amount of commodities as indicated in the standard warrant and use the futures price to take delivery overseas. So much for the innovations, and here we move on to the last part, namely the activities regulated by the foreign regulatory authorities. Before we reach out to the section that INE or the Chinese futures firm member onboarding global investors, I would like to talk a little bit about the 4 fundamental models that overseas participants could use to access and trade on INE's platform. Let's check on the right part of the slide. In Model 1, overseas investors may turn into a client of Chinese futures firm member and directly trade through such Chinese FF member of INE, plain and simple. Model 2 is a bit complicated. An overseas client may also choose its local futures broker to carry his or her orders and participate in INE's trading. However, such futures broker has to be legally incorporated for at least 2 years and licensed for intermediary business in the host country, who has already signed an MOU with the CSRC. According to CSRC's website, until September 2020, there are 65 countries and regions security regulators that have signed an MOU with the CSRC. In INE's rules, we have given these foreign brokers a name of an overseas intermediary. These overseas intermediaries put all its overseas investors' orders in an omnibus account and then execute and clear trades through a carrying broker, either a Chinese FF member or an OSBP of INE, following the principle of one trader, one ID encoding policy. In Model 3, we have to introduce a new term, that is OSP. An OSP is an overseas entity that is approved by the INE directly engaged in trading, including overseas traders that directly conduct trading on INE. We call it Overseas Special Non-Brokerage Participants, the OSNBP, and overseas brokers that directly engage in trading with INE, as we call it the Overseas Special Brokerage Participants, the OSBP. Having a direct trading right, an OSBP may help their overseas investors execute trades on the exchange. But in terms of clearing, it still have to clear and settle trades through its contracted carrying broker, who must be an INE's FF member. Model 4 is rather similar to Model 3. An overseas trader or industrial entity could apply for being an OSNBP with a direct link to the exchange. Same as OSBPs, an OSNBP could trade directly on INE, but has to clear and settle trades through a Chinese FF member as well. Here we move on to the last part of today's slides, the jurisdictions that INE have completed as basic regulatory research. Nowadays, we usually think of futures trading as a regulated financial activity. In order to protect the stability of financial markets and to protect the economic interests and safety of domestic investors participating in overseas futures trading. Most countries with a mature financial market often require foreign trading venues or brokers to register with local authorities before providing trading service for domestic investors. Since March 26 of 2018, the launch of crude oil futures has brought in the participation of overseas investors. Up to now, the number of overseas investors has exceeded 300, and the position commands approximately 20% of the market. These traders come from 23 countries and regions over 5 continents, which is quite representative. Meanwhile, INE now have 2 registered OSPs from Hong Kong and 68 overseas intermediaries. Foreign brokerage companies have become a bridge to introduce the international market and overseas investors into our market. In the upfront slides, we have talked about how could foreign traders participate in China's futures market. Now I will separate them by jurisdictions and try to specify the do's and don'ts between the different models. Up to now, INE have summarized a list covering 58 countries and regions regulatory research. In the list, here in Asia, we have Hong Kong, Macau, Taiwan, Singapore, Japan, South Korea, Mongolia, Israel, Thailand, Indonesia, Vietnam, Philippines, Sri Lanka, Cambodia, Myanmar, Qatar, Kazakhstan, Saudi Arabia, UAE, Oman, and Malaysia. In Europe, we have United Kingdom, British Bermuda Island, Virgin Island, Cayman Island, Guernsey Island, Russia, Ireland, Luxembourg, Switzerland, Cyprus, Germany, France, Spain, Italy, Portugal, Belgium, Norway, Iceland, Netherlands, Greece, Monaco, Sweden, Denmark, Finland, and Bulgaria. In America, we have United States, Bahamas, Brazil, and Canada. And in Africa and Oceania, we have Seychelles, Mauritius, Angola, Australia, and Marshall Islands. Some in the market may have already seen this list and call it the exchange-wide list. I also associate myself with the wording white list, but with a few emphasis. It is sometimes mistaken that investors from the countries or regions in the list could enter China's market unconditionally, which is very incomprehensive and wrong. What needs to be clarified is that although INE does accept account opening applications from the investors in the list, account opening institutions for such investors, namely Chinese FF members, OSBPs, overseas intermediaries, have to take appropriate precautions to make sure their brokerage activities comply with local laws. For example, EU countries often have similar regulations pursuant to the MiFID II, that is Directive 2014/65/EU, either in Model 2 or in Model 3. Chinese FF members wishing to provide investment services to clients from EU countries, either directly or indirectly, have 2 ways to do this. Either obtain a cross-border third country license or establish a branch in the home country if the services are provided to the retail investors or elective professional investors. But in case EU investors decide on their own initiative and hire the investment services provided by the Chinese FF member without any solicitation made by the Chinese FF member, the Chinese FF members would not be considered to be providing investment service in the EU. This would be known as the reverse solicitation, and in consequence, the authorization would not be required. However, our lawyers strongly recommend that Chinese FF members relying on reverse solicitation carefully document how the client relationship come about. This includes who initiates the provision of a particular product or service in order to be able to demonstrate that the reverse solicitation exemption was in fact available. As in general, any marketing that is targeted at clients in EU countries risks making the reverse solicitation exemption unavailable. As for the United States, which is subject to CFTC Rule Section 30.4 subsection A, Chinese FF members would be required to register as an US FCM prior to taking clients from the United States. This makes Model 2 unfeasible. However, according to the CFTC Rule Section 13.4, If a Chinese FF member carries a customer omnibus account for a US FCM for the purpose of executing orders for customers from the US FCM, the Chinese FF member would not be required to register as an FCM. Thus, in this circumstance, Model 3 is workable. Anyway, there are many other issues that need to be considered for Chinese FF members when onboarding global investors, and vice versa for foreign clients or brokers looking for Chinese associates. Does the client need to be a professional investor? Does a country have currency control regulations? Can I hold roadshows or promotional tours in certain countries? How could I fulfill the obligation of information submission regarding to CFTC rules after onboarding US customers, etc.? Therefore, due to regulations that might change or renew constantly, we strongly recommend that clients and brokers pay close attention to local financial restrictions when conducting specific business. Hire professionals to provide suggestions when necessary. Okay, this is for my sharing. Thanks for listening. Should you have any queries on the presentation, please do not hesitate to contact us. Bye.